Welcome to Woods of Stardom. This is CH. I will be covering the JPMorgan Global Bond Opportunities Fund in this video, which is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. This video is done as a follow-up request from a viewer's comment in my previous video covering the PIMCO GIS Income Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos, and I'll be happy to work on it as long as I can find enough information on the product. JPMorgan Chase is a leading global financial services firm with over 225 years of history and currently managing over $3.9 trillion of assets across a wide range of businesses. Chase is primarily a US-focused consumer and commercial banking brand, while JPMorgan is for global banking and financial services. JPMorgan Asset Management, as the name implies, is the asset management business for JPMorgan globally. JPMorgan Asset Management manages over $3 trillion of AUM across equities, fixed income, multi-asset, alternatives, and liquidity solutions through more than 1,300 investment professionals. These are slightly outdated statistics on their website, so I imagine these numbers will all be bigger by now. The JPMorgan Global Bond Opportunities Fund is a sub-fund under the JPMorgan Funds fund family. JPMorgan Funds is set up as a Luxembourg SICAV structure and is UCITS compliant. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The JPMorgan Global Bond Opportunities Fund has a very large 6-person co-manager team, and as per the information provided in the fund webpage, they all have at least 24 years of industry experience. It is rather uncommon to see this kind of setup, as most funds will have either one key manager or at most just 2 to 3 senior managers running a solution. The Singapore version of the fund webpage provides link to only one of the co-managers' bios, but Googling the names can easily get to all their respective bios in the JPMorgan US website. Bob is the Chief Investment Officer and Head of the Global Fixed Income, Currency and Commodities or GFICC Group. He also sits on various investment and operating committees in the firm. Ian is the International Chief Investment Officer in the GFICC Group. He is co-managing several multi-sector bond solutions in the firm. Lisa is the head of Global Investment Grade Corporate Credit Team in GFICC Group. Besides this fund, she also co-manages several other credit and corporate bond solutions. Andrew is the head of mortgages for macro-driven strategies in the GFICC Group. As per the role, he is responsible for overseeing the mortgage-related securitized assets exposures in this fund and others. Jeffrey is a credit analyst within the Global High Yield team. He is co-managing several multi-sector bond solutions that Ian is also involved in. Andres is the head of Global Credit in GFICC Group. He is also co-managing the same multi-sector bond solutions that Ian and Jeffrey are involved in, plus others. Morningstar shows that the fund was initially managed by Bob and Ian since incepting in 2013. Lisa, Andrew, and Jeff were added in 2020, while Andreas was added only in 2025. There were 2 other managers who are no longer in the fund, but overall the team looks pretty stable. While I didn't see any clear marketing on the positioning of the fund in the firm, this star-studded manager team certainly makes it feel like JPMorgan is treating this fund like a best ideas flagship product. From the bios of the managers, it also appears that the fund has a higher focus on corporate credits in both investment grade and high yield space, as well as mortgage-backed securities. Let's take a look at the fund strategy next. The investment objective of the JPMorgan Global Bond Opportunities Fund, as per stated in the fund webpage and fact sheet, is a short sentence, but actually covers quite a bit of information. Here, it tells the investors that the fund has a predefined benchmark and that the fund's objective is to outperform that benchmark. Having a clear performance target with a comparable benchmark helps investors to assess and appreciate the expected returns of the fund and whether the fund is delivering as intended. The fund runs an unconstrained portfolio, meaning it is not bounded by the benchmark in terms of its portfolio construct. We know from the fund name that this is a global mandate. It is stressed here that the fund will invest opportunistically, suggesting that there might be a focus on shorter-term or tactical investments, and that the fund might take on higher risk investments when it is worthwhile to do so. The portfolio includes debt securities that are bonds of all categories. Currency play looks to be a main investment scope as well, though we will see if the fund provides any details on returns attribution. Derivatives is mentioned here, but we will need to find out what kind of derivatives are included, as this should not end up like a complex hedge fund strategy. The prospectus provides a short description on the investment process. This is a fund that runs a combination of top-down macro view and bottom-up bond selection. The top-down macro part is a research-driven investment process covering countries, sectors, and issuers, and analyzes fundamental, quantitative, and technical factors. The bottom-up selection process is simply stated as an unconstrained approach to find the best investment ideas with a focus on generating long-term total returns. It is mentioned that the portfolio will dynamically adjust sector and country and duration exposures depending on market conditions. It would be nice if JPMorgan can provide more details here, as these are still pretty vague and generic descriptions. The benchmark of the fund is Bloomberg Multiverse Index. As mentioned earlier, the fund is unconstrained by the benchmark in terms of the portfolio construct, but treats the benchmark as a performance target to overcome. The Bloomberg Multiverse Index is not commonly seen and sounds like it comes from some comic or fictional movie, so let's take a quick look and see what it really is. This index is actually a combination of various Bloomberg bond indices. The main component is the Global Aggregate Index that is most commonly seen and used in the market. As the Global Aggregate Index covers only investment-grade bonds, the Multiverse Index adds on the Global High Yield Index and the Euro Treasury High Yield Index into the mix, as well as additional emerging market local currency debt beyond the 5 EM countries in the Global Aggregate Index. This results in the Bloomberg Multiverse Index that has a much more comprehensive coverage than the Global Aggregate Index, and in theory would ideally better represent the global bond universe. However, adding all these additional components makes the index too complicated to implement as an investment product, since some of these bonds may not be liquid or large enough to invest in. As a result, currently it seems that there are no ETFs or funds that track the Bloomberg Multiverse Index, and investors are happy with existing solutions that track the Global Aggregate Index or the Global High Yield Index individually. The nearest match I found is the LNG Global Bond Multiverse Index Fund that tracks a customized version of the index and was only launched in 2025, so we can't really use that for long-term comparison. What this means is that while we can't compare the fund performance directly with an ETF, since there isn't one that tracks the benchmark index, we can still see how the fund compares against various ETFs that track different components of this benchmark index. The prospectus then provides a long section on the investment restrictions in the portfolio. As usual, I have excluded the ESG stuff since they are mostly generic descriptions and don't really have a meaningful impact to the investments. Here it states the fund needs to have at least 67% invested in bonds of all categories. As this is a pure bond fund, I would expect this to be much higher, of at least 90% in actual implementation. More specific investment restrictions include max 10% in convertible bonds, max 10% in cocoa bonds, and max 10% in equities. There is a guidance of up to 30% in securitized assets including MBS and ABS, although it is mentioned there is no hard limit for this category. The fund can also shift up to 100% of the portfolio into deposits and money market solutions if needed. This provides high flexibility for the fund to completely avoid the market in event of significant market volatility or drawdown. It is also briefly mentioned that the fund can use derivatives to implement long and short positions of countries, sectors, currencies, and credit rating exposures, with no restrictions specified. Again, we will see later if the fund discloses the actual derivatives usage in the portfolio. The base currency of the fund is US dollars. However, given the investment objective and investment policy mentions about currencies, it is possible for the fund to take active non-US dollar exposures and use FX as part of the returns generation strategy. Let's look at the actual portfolio next. The JPMorgan Global Bond Opportunities Fund was launched in 2013, giving it well over 10 years of track record. Fund AUM is currently at $4.6 billion US, which is a decent size for a global diversified bond solution, but can definitely grow a lot bigger. JPMorgan provides pretty detailed information on the portfolio in the fund webpage, which is good for investors. Here is a sector breakdown that looks a bit confusing though, because it is sorted by allocation percentage. I've done a quick reorganization and consolidation of some of the items here. On the left side, we can see that the fund has about 71% in developed markets exposure and 22% in emerging markets exposure. The EM exposure here is slightly high compared to most other global diversified bond funds in the market, suggesting there is a deliberate focus on EM, even though none of the co-managers seem to be dedicated to the EM space. On the right side, we can see the fund has a high allocation of over half of the portfolio in corporate bonds, of which about 34% in developed market investment-grade corporates, 22% in high-yield bonds, and 3% in EM corporates. Sovereign bonds take up only about 21%, and securitized assets only about 11%. The high corporate bond exposure is a reflection of the co-managers' experiences, as mentioned earlier. Although, I would have thought the fund should have more MBS exposures for the same reason. Country breakdown-wise, there is a very long list of tail-end exposures of less than 1% that I have not included here. A quick calculation shows the portfolio has slightly more than half in North America, about 27% in Europe, 10% in Latin America, just 5% in Asia, and the remaining 5% in the rest. This is where different active funds and indices can vary quite a lot. For example, Bloomberg Global Aggregate Index has lesser US exposure in exchange for much higher Asia exposure, or the popular PIMCO GIS Income Fund that has a lot more US exposure and minimal in the rest. There is no right or wrong here, as the bond universe is big enough for different fund managers to find different investment opportunities available. Currency breakdown shows that the portfolio is almost fully exposed in US dollars. So while the fund's investment objective seems to indicate that FX can be a returns contributor, it doesn't seem that the fund is currently making any significant FX bets. Credit rating breakdown is also provided, and we already gathered from the sector breakdown earlier that the portfolio has about 1/3 in high-yield credit rating. The portfolio currently has an average duration of 5 years, suggesting the managers are not too concerned with interest rate risk at the moment. Yield to maturity is 6.2%, which is a decently high number that should be mainly attributed to the high-yield bonds and EM bonds. Top 10 holdings are available, but not too useful for global diversified bond strategies, as it would simply show sovereign bonds and MBS, since these bonds are large in size and liquid, and therefore easily scalable according to the fund's AUM. Morningstar shows the fund has well over 1,200 bond holdings in the portfolio. That is expected of such strategies. The fund unfortunately doesn't seem to provide any information on derivatives usage. Morningstar shows some short exposures in the portfolio, but without details, we don't really know whether they are just for portfolio hedging purposes or are actually deliberate investments to generate returns. The JPMorgan Global Bond Opportunities Fund currently doesn't seem to be heavily marketed in the region. For the Singapore retail market, only the retail A class in base US dollars and Sing dollars hedged versions are available. The fund does have various other currency share classes, but do not seem to be registered for Singapore retail market. The US dollars and Sing dollars hedge classes comes in both accumulation and monthly distribution versions. We will go through the distribution details shortly. The retail A class has a 1% management fee. Adding other expenses gives a total expense ratio or TER of around 1.2%. Up to 73% of the management fee can be paid by JPMorgan to distributors as trailer fees. Distributors are allowed to charge up to 3% subscription fee for this fund. Although I think anything more than 1% for bond funds with low return expectations is excessive. Some distributors may offer the C or C2 classes that are normally meant for Europe, or the institutional I class. These share classes have no subscription fees as well as a much lower TER than the A class. Investors interested in this fund should try to access these share classes if available. Distribution data of the JPMorgan Global Bond Opportunities Fund should be consolidated together with other funds in a separate dividend information PDF document, but strangely is not found in this document or anywhere else in the JPMorgan Singapore website. Fortunately, Morningstar has the distribution data and we can calculate the 12-month yield of the fund is currently around 4.7% to 4.8%. This is a slightly lower payout yield compared to some of the other popular global diversified bond funds in the market that are still maintaining a payout yield of around 6% or higher. While payout yield is part of a fund's total return, and there is nothing wrong for a fund to have a lower payout yield but higher capital growth, having a relatively lower payout yield is visually less appealing to some retail investors from a marketing angle. We can also see from the data that the fund has a smoothened payout policy on the distribution amount, which is reviewed and adjusted quarterly. This is a common approach for retail share classes of bond funds. From the total return versus NAV growth chart here, we can also see there has been a slight difference in the prioritization in the fund before and after the 2022 bond market crash. Prior to that, the fund's NAV had been maintained in a slightly declining range, suggesting the fund prioritized distribution payout at the expense of NAV. Post-2022, the NAV range is showing a slight incline, suggesting that the fund seems to want to slowly grow the NAV and therefore is not giving a payout yield as high as possible. The JPMorgan Global Bond Opportunities Fund provides performance data across various time periods and includes benchmark data as well, which is good. Calendar year performance is however missing, and we can only get the fund's data but not the benchmarks data from Morningstar. As usual, we will ignore the line that includes max subscription fees because it doesn't make sense and is irrelevant to the fund's performance. Based on the data available, the fund has outperformed the benchmark quite comfortably across all time periods, in particular for the since inception period of about 13 years worth. The fund managed to outperform the benchmark by about 0.8% annualized. That being said, the fund does exhibit periods of high volatility in conjunction with the bond markets. On calendar year basis for the past 10 years, we can see that the fund delivered as high as 10.2% in 2019 and as low as minus 6.8% in 2022. The fund webpage also nicely provides a performance chart that compares the fund against the benchmark with monthly data points. It can be seen that the fund was struggling to outperform the benchmark before 2021, but after that managed to do much better and slowly increase the outperformance. This suggests the fund had made changes to its investment approach around that time, possibly with the help of the additional co-managers that joined in 2020 that turned out well. Let's run some Morningstar comparison charts. Here is the fund compared against various ETFs representing different bond market segments. Since 2018, as some of the ETFs do not have a track record as long as the fund. We can see that the high allocation to corporate bonds has helped the fund deliver a very decent performance versus all these individual market segments. Global High Yield was the only one that outperformed the fund, but it comes with much higher volatility through this time period. On a shorter term basis, the fund hasn't done so well though. Looking at full year of 2025 plus January this year, while the fund delivered a decent 8.9%, it is actually lagging behind most of the ETFs except for global government bonds. As sovereign bonds exposure is quite small in the fund portfolio, I am not sure what has prevented the fund from achieving a better performance in 2025. Perhaps the managers think the market was too bullish and decided to de-risk a little. Let's compare the fund against other global diversified bond funds in the market. Here is a chart comparing with some of the popular funds since 2017. The JPMorgan Global Bond Opportunities Fund shows a pretty high correlation with several of these funds that are all moving very closely through this time period, with PIMCO GIS Income Fund emerging just slightly ahead. On a shorter term basis again since start of 2025, we can see these funds are still very highly correlated to each other. The JPMorgan Global Bond Opportunities Fund did have the worst correction in April 2025, but managed to recover and ended up only behind PIMCO GIS Income Fund and Neuberger Berman Strategic Income Fund for this time period. Last but not least, let's take a look at the differences between the US dollar class and the Sing dollar hedge class of this fund. The performance difference is purely the currency hedging cost of the Sing dollar share class. And we can see that while there were some small gaps in the earlier years, the recent 2 years have the widest gaps as currency hedging costs for Sing dollar share classes on a US dollar based currency fund has been really high at around 3% per annum. As a result, this makes global bond funds less appealing to Sing dollar investors currently from a performance perspective. Investors therefore do need to consider carefully how to balance Sing dollar focused bond funds versus global bond funds in the current market situation. With that, let's summarize our findings. The JPMorgan Global Bond Opportunities Fund is a product from JPMorgan AM, a global leading asset manager that is under the large JPMorgan Chase business. The 6-person manager team of the fund includes various group and team leads in the firm, suggesting a high emphasis to make the fund successful and also possibly to make this fund a flagship bond solution. While this is a straightforward investment strategy of global diversified and unconstrained bond solution, the investment process details are rather lacking, making it difficult for investors to understand how the fund works. The fund doesn't seem to be actively marketed by JPMorgan, as there doesn't seem to be marketing brochures and featured fund web pages that would help to better explain the fund to investors. The fund does have a pretty well diversified portfolio in terms of geographic exposure. It also has a clear focus on corporate bonds of both investment grade and high yield nature, which differentiates it from some other global diversified bond funds in the market that are heavy in securitized assets. On the other hand, while the fund's mandate clearly indicates the ability and desire to use FX and derivatives as returns attributors, The fund seems to have minimal usage in this. As such, I think there is potential for the fund to deliver better results if it were to improve in these areas. Distribution data seems to be missing in the JPMorgan website, so the team should get this fixed quickly. The fund has managed to outperform its benchmark and has done it more consistently from 2021 onwards, possibly with the help of the additional co-managers that joined in 2020. The fund has delivered a decent performance versus peers in the long run that can be considered as above average. In conclusion, the diversified geographic exposure and the corporate bond focus makes the JPMorgan Global Bond Opportunities Fund an interesting product for investors to consider, either as a core bond position for those who like its portfolio construct, or as a complement to other existing global bond funds that have high concentration in other specific areas and have less focus on corporate bonds. This concludes my absolutely biased comments on the JPMorgan Global Bond Opportunities Fund, and I hope it will help in your investment journey. May we all grow wiser and prosper.